Welcome to Market Monday from the investment team in the trust department at the First National Bank. We're going to start things off today a little bit differently because we've had some massively important market events over the past few days, and it's worth talking about them first before we get into what's on the horizon with economic reports and how those might impact things. So starting things off with what everyone's been talking about, Silicon Valley Bank. This was a bank that was about $200 billion, so not a small bank. The first and biggest failure of its nature since the financial crisis of 2008. And this bank is focused, or was focused, mainly in technology, startup type companies, venture capital backed companies, and other growth type entities, along with individuals in those spaces. And the company got itself into trouble and announced last week that they were going to sell securities that they held at a loss in order to raise some capital, and in addition to that, they needed to go into the capital markets, issue new shares of stock, and sell those to shore up the balance sheet. And that news was not taken well by its client base, which then proceeded into an old-fashioned run on the bank, taking all their deposits out as quickly as they could. While this was transpiring, shares declined 60% that day. Then, the following morning in the pre-market, they were down another 60%, when regulators at the FDIC stepped in and took the bank into receivership. In other words, they took control of the bank. That action put into doubt whether investors who had deposits over the FDIC insured amount of $250,000 were going to be covered. And there were lots of reports that some relatively large technology and venture-backed companies had significant amounts of their operating cash at that bank on deposit. And that threw into doubt whether companies were going to function correctly in the technology space. And that threw into doubt whether people were going to be made whole, whether they were going to get wiped out and lose lots of money. And it created a panic that expanded beyond Silicon Valley Bank and impacted several other regional banks of high quality, but that operate in the same sort of customer base with the same sort of footprint. So when that was going on over the weekend, the Federal Reserve and United States Treasury and other officials in Washington got together and came up with a package that essentially guaranteed the debt or the deposits of all of the people that had deposits at Silicon Valley Bank, putting a little bit less pressure on the situation and the speculation that there were going to be further systemic problems throughout the financial system. And that appears to have eased things somewhat as of the time of this filming, which is about 2:25 on Monday the 13th. It appears that the market is performing relatively strongly and has rebounded. And let's talk about that because this is hugely significant. The S&P 500, going back a year, has been this rough ride. But toward the end of last year, I'll point this out again, we've pointed it out many times, toward the end of last year, it held a very tight range, just over 3,800. And today, right around the open, right after the open, we got back there. And the market still, even in the throes of a mini financial panic, couldn't get below that 3,800. We're taking that as a pretty bullish signal, and, with good reason. And that doesn't mean we're out of the woods. Volatility remains elevated. And what I'm pulling up now is the VIX index, which measures volatility expectations over the next 30 days in the S&P 500. For a brief bit today, it was above 30 right around the open. And a number of 30 is generally regarded as the dividing line where, extreme volatility is becoming the expectation. It only remained there shortly today and came right back down, and now we're trading under 26, which, while still indicating a high level of volatility is expected, is much more within the realm of normal. So, are we out of the woods yet? No, probably not. However, is this a full-blown panic crisis that's likely to escalate further? It doesn't appear that way from the market's behavior right now. And, we're going to return to the S&P to close. Let's talk about, what are we getting from the fixed income markets? And what basically is happening is 2-year yields have come down 79 basis points. That's almost 0.8% in the past week. Most of that within the past few days. And that is a hugely significant move because it indicates that expectations for the Federal Reserve, rate hike peak overnight rate are likely coming down. And the 10-year paper has come down 44 basis points. That's almost 0.5%. That indicates that inflation expectations over the long term are also coming down. And, this type of activity is saying the Fed's hands are likely tied because of all this volatility in the market. They're going to be unwilling to spook the market, and they're going to be unwilling to perturb the market by raising rates as aggressively as they had, even in the face of getting some pretty, interesting and powerful, what would have been market moving information on inflation in the next few days, particularly the consumer price index, which is supposed to come in. Expectations are it will show a 0.4% rise on a month-over-month basis and a 6% rise on a year-over-year basis. We're not sure this number is really as relevant as it was before. I mean, yes, both of these show a decline on the month-over-month from last reading, but even were they to come in hot right now, markets are expecting the Federal Reserve to have its hands tied and be unable to go in and do what it needs to do to stem inflation. And in fact, the more important consideration would be to avoid allowing this financial stress to continue. So interest rate futures actually appear to be pricing in either no rate hike at all at this meeting in March that's expected, or a 25 basis point hike at a maximum. And that happened very quickly, that reset in expectations. We get that information tomorrow, what happens with the CPI. Producer price indexes will come the following day. And again, these are news releases that were highly market moving over the past few months, but we don't think are going to be that way, for right now, because the market just seems to have bigger fish to fry. We get information on sales and manufacturing, what's happening with the economy. All of that's expected to show contraction in activity. We get information on the housing market and then sentiment. Not a whole lot of data points over the next couple of weeks, but the ones that are, while usually they would have been consequential, may not be as much anymore. We think markets are largely going to be driven for the foreseeable future, the next week or so until volatility calms down, by these financial considerations. With that said, should we get numbers that indicate inflation is coming well under control, we could very well see this market rally on the basis of that, because that would say that the Federal Reserve can take the hands-off approach without risking inflation returning as viciously as it had been growing, and allow the economy and allow the financial system time to heal without manipulating it and without producing more inflation. That would be what we would consider to be an ideal scenario, and so would many market participants. Closing, let's come back to the S&P 500 and take a bigger picture view. You're used to this view if you've been watching our videos, where we're going to zoom out over the longer term, because the chart I'm showing you now is scary. Yes, it is. The longer term, though, is where we're investing for. So if you've looked at the news headlines and you're hearing about all of these scary things that have transpired over the past few days, and you're wondering whether I should sell my stocks or how I should proceed, we're advocating, investing for 5 years, 10 years, 20 years. Take the bigger picture view, and it's a much smoother ride. And, looking at this long-term chart, which is 20 years in the S&P, this period I'm circling was the 2008 financial crisis. And it was a time when the entire system was, apparently close to failure. It wasn't going to fail, but it sure looked that way, and it sure felt that way at the time. Then we had, that panic in 2018 toward the end of the year, that terrible December. Then we had 2020 with COVID, which was a sharp decline. And then we had last year, which is probably the first real bear market that we've had in a while. But it appears, to have found a stable point, at least for now. And, taking the longer term view, knowing that our plan is designed for that time frame and time horizon, and that we're not wanting to injure that plan by making decisions based on short-term events, is the way to go. So if you are nervous about your portfolio, if you're worried about the economy, if you want to talk to us and find out what our thoughts are, we're here to talk. We're happy to talk. And we look forward to having those conversations. It's our job to keep you on the right track over the long term. So hopefully you found this video useful. Thank you and have a great day.